If you're a real estate investor, you might have heard of the term cap rates. In a nutshell, cap rates are used to compare rent yields between properties. What we find is that the calculation of cap rates is actually frequently misunderstood, which leads to it being used incorrectly. In this video, I'll dive into cap rates, what it is and how to accurately calculate it, what makes a good cap rate, typical cap rates in Toronto, and ultimately how to choose the best investment opportunity using cap rates plus other factors to consider. Before I continue, please remember to subscribe to our channel and hit the notification bell so you don't miss other real estate investing videos like this from our Elevate team. Cap rate is short for capitalization rate, and it's used to compare unlevered rent yields between properties. And before you properly use it, you need to make sure you calculate it the right way. You get a property's cap rate by taking the net operating income and dividing it by the market value of your property. Operating income is how much you receive in rents minus your operating expenses before your monthly mortgage obligations. Operating expenses would include things like utilities, insurance, property tax, condo fees, maintenance, and even vacancy allowance. Now let's look into this a bit more. First of all, appreciation is not taken into account. So just because your property has a great cap rate, it doesn't necessarily mean it's the best investment. To really find out if you have the best investment opportunity, you should look at total returns, including appreciation and other factors as well. I also mentioned that cap rate is a metric that compares unlevered returns. So this means it doesn't take into account mortgage obligations, and quite a few investors get this wrong, so we really want to stress this. Note that your total returns can look better when you increase your leverage, but this also means that you're increasing your risk as well. Next, it's important to know that you should use the market value of your property when calculating cap rates. If you're trying to calculate the cap rate on an existing property that you have, you really need to understand the current market to arrive at this number. And this is especially trickier for houses since they all have unique characteristics in terms of things like size, features, condition, and parking. I want to highlight that you shouldn't use the purchase price that you got it for possibly years ago, which really inflates your cap rate and doesn't make your cap rate an accurate comparison in today's market. This also means that if you buy a property and renovate it before renting it out, you shouldn't just use the total cost that you put in. In the same way, using your cost instead of the market value can also artificially inflate your cap rate because it doesn't take into account your own value add efforts. Essentially, value add appreciation was left out of the picture, so again, their cap rates would be unrealistically higher. Now, assuming we calculate cap rates the same way, the next question is, what makes a good cap rate? Here on our Elevate team, we like to invest in real estate with more balanced returns that enable us to scale effectively. This means we prefer to invest in real estate that offers positive cash flows after our mortgage payments since it's a more secure investment. So here's a quick and rough trick that we use on our team to check for cash flows. Add 2% to your mortgage rate. This will give you a ballpark cap rate that generates break-even cash flows after paying your monthly mortgage payments, including interest and principal pay down. If you're getting a cap rate that is higher than that break-even cap rate, you're likely generating positive cash flows, which means a more secure real estate investment that generates better rent yields. Now that you know what makes a good cap rate, let's go over typical cap rates in Toronto right now. As a reference, at the time of making this video, we're at the end of 2020. Because of COVID, rents have dropped around 10% compared to before March. So with adjusted lower rents, typical cap rates in Toronto condos are at around 2 to 2.5%. Houses, 3 to 3.5%, and commercial properties, 3.5% plus, but these can definitely vary by neighborhood. As you can see, cap rates for different types of properties are different. Like I mentioned before, investors typically look at total returns instead of just cap rates. When market appreciation varies, you'll likely see varying cap rates as well. In the case of Toronto condos, some investors were willing to take on very low cap rates, even with negative cash flows, in exchange for a higher appreciation potential versus freeholds. And this is pretty speculative. In this case, they had a heavy weight on appreciation, so when appreciation stalls, like what's happening now, their investment is at greater risk compared to a more balanced real estate investment. And of course, location definitely matters. Different cities, neighborhoods with varying gentrification potential can all affect their cap rates, so this is something you need to keep in mind. When you get to know investment properties a bit more, you'll actually find that cap rates and appreciation offset each other. The reason why some cities have great cap rates are to compensate for much lower appreciation. So again, you really need to look at total returns to see how an investment really is. For example, Calgary may have cap rates that are 1% more than Toronto, but appreciation in Calgary is close to zero. So the total returns actually aren't as good as Toronto freeholds, with a better balance of decent cap rates and appreciation. And if two properties have similar total returns, it's a good idea to choose one that has a better balance of returns from appreciation, rental income, value add potential, because this will lower your return concentration risk. The key takeaway is that cap rates are useful for comparing investments that have similar characteristics. But if they aren't very similar, then cap rates shouldn't be the only metric you use. The best way to compare real estate investments is really to look at total returns from appreciation, rental income, value add potential, and even loan to value ratios, which can affect your leverage. The reason we love Toronto freeholds is that we find that they offer a good balance of returns, and this brings a good combination of attractive total returns and reduces return concentration risk. And in this pocket of opportunity in Toronto, they are still not all the same. There is a small subset that can offer higher cap rates, which make them the best opportunities in Toronto. If you have a similar mindset and want us to help you secure an investment property that has a good balance of appreciation and positive cash flows, reach out to us and we'd be happy to help. Finally, if you find this video useful, please give us a thumbs up and help us out by sharing it on your social media and tag us at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.